kind of starting spot is I'll get people who come to me and they're making, 100 grand a year. And if you just look at their withholding, like if you just take the amount of withholding on your paycheck and divide it by your amount of wages, if that's less than 10%, there's a good chance you're not withholding enough. So like just sort of look at that. And if it is at
That's
that
a good
point,
rule of thumb. I never heard that. Yeah.
take a look
Yeah,
at your
that's
tax
awesome.
return, just because that's kind of the lowest bracket. So if you're holding less than that, depending on what you earn, but go to your accountant early in the year.
All right, guys. Hey, got another great episode of the Practical Wealth Story Show for you today. I have Miss Natalie Kolodij, and we're going to talk about taxes, okay? How to save money, mistakes people make, especially for real estate investors. So I need y'all to perk up. Let me tell you a little about Natalie. Natalie is a real estate tax strategist. See, there's tax preparers and there's tax strategists. So I got y'all strategists today, right? Natalie is an enrolled agent. A real estate tax strategist. She's worked exclusively with real estate investors since 2017 and cultivate tax strategies for those building wealth through real estate. She started her journey. We're going to talk a little bit more about that. Investing, flipping mobile homes to resell, owner financing, and now focuses on buy and hold because she wants to create wealth. All right. And so she's been on shows like, Bigger Pockets, and we'll give you all her stuff. She's got over 50,000 YouTube views, 35 speaking engagements. So she's out there and she's out there crushing it. Natalie, welcome to the Practical Wealth Show. I'm so excited to talk to you.
Hi, Chris. Thank you for having me. I'm excited to talk about taxes.
Isn't that interesting? Excited to talk about taxes. I love that. Me too. And so tell them what I didn't tell them, what started your journey? How did you did you grow up wanting to be an accountant? What's your origin story? Did you get bit on the arm by bit on the hand by a radioactive spider? Tell me.
Yeah, radioactive calculator turns you right into an accountant.
Right.
No, for me, I knew I wanted to be an entrepreneur. I knew I wanted to be involved in business, so I was getting a general business degree. But I feel like everyone and their grandmother tends to graduate with a business degree, which is good and bad. You can do a lot with it, but you can do a lot with it. So there's no like specialization to it.
Right.
So I ended up really liking the tax classes. So I, focused down and ended up getting my degree in tax instead, specifically. And then the same time, I kind of just started getting interested in real estate. I don't remember what I had seen that initially sparked it. I just sort of had heard and seen that this was how you built wealth. And I got into that the way I strongly advise people not to now, which was I paid for one of those like expensive weekend guru seminars.
Okay.
From that, what I had was a ton of questions, and that's how I found Bigger Pockets originally. So I was on there learning real estate and at the same time helping people with tax stuff. And it just sort of grew from there with this sort of cohesion of both of these topics because there's so much overlap.
That's cool. And so I love that you're doing the thing. So you're doing the thing you're talking about, and then you have an expertise. So when you're looking at it, because when working with clients, a lot of times I'll speak at real estate workshops and I look at their returns, and one of my goals this quarter is I'm going to get really good at reading tax returns, but I don't want to do them. I just want to be able to, let's say we're working together. I just want to have good questions with you. I want you to figure you're the expert, right? So I know enough to be dangerous, and then I hand them off, right? And but what are some of the let's start with why real estate is a good tax I don't know the right word. It's tax advantaged asset.
Yeah, absolutely. So with real estate, there's a ton of benefit, but kind of the biggest one right off the bat is just if you think about any of your earned income, right? So like if you go to a job, you work for an hour, you make $20, they're going to take 15% and then some out in taxes. And a lot of that is payroll tax, your FICA, Medicare, Social Security, all those little taxes. So that's you pay half of that when you're working for someone, like you pay half the payroll taxes, your boss pays half. If you're self-employed, you pay both halves. But if you are a real estate investor, or if you have rental properties, they are not subject to that tax. So everything you earn does not pay those extra payroll taxes on it. So right off the bat, you're getting 6 to 15%, depending on if you're currently an employee or self-employed, more. Like you get to keep that much more of your income versus, going out and working for it, working a 9 to 5. And like, so that's just kind of the basic benefit. But
Right.
at a high level, what I'll say is that the people in America who make our tax laws are largely real estate, own real estate.
Right.
So there's always going to be benefit in there for them.
Right.
So
Right. Right. Right.
you might as well line that up for yourself as well.
I tell our clients there's two tax codes, one for wage earners, one for business owners, really designed for
Mhm.
business owners and landowners or real estate owners, in general. And so you have to get yourself on that side of the game. Like it's
Yeah.
not even optional, you know.
Yeah, absolutely. If someone comes to me for taxes and all they have is a W-2 job and no real estate, no side hustle, nothing else, we're really limited on what we can do. That's not just fully fund retirement, which is great, but that's not, we're just putting money in a different bucket. There's not
Right.
much we can do to reduce that taxable income without you not having access to the funds right now. But
Right.
as soon as you get into business or real estate, we have far more flexibility.
Yeah. And it's funny, qualified plans, I'm gonna go, that's a whole, I'm working on a show on this, just defer taxes, right?
Mm-hmm.
And or the more accurate word is postpone taxes. And you can end up paying higher taxes later if you don't have a good exit strategy. And so a lot
Yeah.
of people are lazy. I was reading this. The average 90% of households in the US earn, what I'm studying right now is the difference between what's the two to actual and what's the other one? Estimated taxes. The progressive
Oh,
tax
like your
system.
effective tax rate.
Effective, right?
Yeah,
Effective
yeah,
tax
yeah.
rate.
Mm-hmm.
And so the average household makes $120,000 a year. 90% of households in the US make less than $120,000 a year. So their effective tax rate is 8.8%. So now if they put 10,000 in 401k, they're saving $800.
Mm-hmm. Yeah, it's
But
not huge.
that's not huge. And then, but when
Yeah.
they pull it out, they could be paying 20-30% taxes on that on the back end. And nobody talks to them about that part. So that's
Yeah,
another
and
show.
it's
But I've been getting my mind around that. What now? You know?
yeah, it comes into play with taxes too, because a lot of tax professionals, and I think the problem is like our clients, they don't always know, like to them saving the most money today or getting the most of a refund today to them is like a sign of a good advisor.
Yes.
But saving $100 today, if it's going to cost you $300 tomorrow, isn't always the best strategy. But someone wants the
And right,
instant
you want to
money
be a
in hand.
hero and
Yeah.
let me show you how to throw this money into a solo 401k or whatever. But nobody, that's short term.
Yep.
I had a person I referred sent somebody that, and I was like, all right, I almost cursed her out. It's like, listen, that's lazy. Okay.
Yeah.
And so you better figure out an extra strategy if you're going to give out this advice and be lazy like that. So don't get me started. I'm a little bit of a contrarian. So let's talk about what about what are some things. So now here's what I want to speak to these people. So I've got two types of people listening to the show, like people that are really good, got a good portfolio, they're full-time investors. But I have a lot of people, and I want to speak to them that are working. They have 1 to 10, 12 units, right?
Mhm.
And I say, look, once you get 1 or 2, I mean, you already are beyond H&R Block, and I got an LLC. So speak to them, like, what should they be understanding and asking questions of their advisor? Because I'll look at that going, I don't think you're missing something. Something being missed here.
Yeah, yeah. And with that, it's so tricky because I think especially new investors, so many start with house hacking, right? They're renting out a unit in a fourplex or rooms in their house. And it's an awesome strategy for new investors. But tax wise, it's one of the most complicated ones because now you don't just have a clean business, you've got personal use of a business asset basically.
Mm-hmm, mm-hmm.
So it's like the thing you start with is probably more complicated than if you would have just gone and bought 10 rentals.
Hmm.
So when it comes to what they should be looking at, what they should be looking for, what questions they should be asking, I would say for the start to just save your money on an H&R Block, Turbo, or like any of the sort of cookie cutter chains.
Yeah.
um they're probably going to be pretty on par with what you could come up with yourself, honestly. Like if
Hmm.
you have to be at that price point, you spending 10 hours sort of reading some good resources and going from there is probably going to get you farther than the seasonal employee there.
Okay.
Um, there's two paths to it, you know. The biggest things to be mindful of when you're setting up your property and kind of where we see the most issues, and
Hmm.
this is the most important thing because it carries on with the property, is setting up your depreciation. So this is one of those other tax benefits of real estate that
Yeah.
we hear about a lot. So you'll hear people say, "Oh, my real estate creates losses, and I get to deduct these losses,"
Right.
and that varies. It depends on your income level and some limitations. But we don't actually want people going out there buying, like, don't go buy crappy properties that are losing you money. Like, that's not the
Right.
goal.
Right. Right. You don't want negative cash flow. That's not
Yeah,
right.
yeah, we're
Yeah.
not
Right.
trying
Right.
to do that. But depreciation is basically the IRS saying this building should be wearing out over time. We're going to let you write off a little bit on your taxes each year. So at the end of the year, even if you've made money, you could have $1,000 in the bank from, you know, after you pay all your expenses, your operating costs. And then on paper, you just get to write off this extra, you know, $2,000. And so to the IRS, you're paying tax on negative 1,000. You have a loss, but you actually have $1,000 in hand. So that's one of those other tax benefits. But that depreciation amount, you set it up the year you put your rental in service, like that you start listing it for rent,
Okay.
and it carries forward every year. So if it's wrong the first year, it's going to be wrong second, third, fourth year until someone notices it and has to like file a big correction.
Mm.
So the biggest things to look for there is to set up your depreciation. You start with your total cost, so what you paid for it. If you Google like what closing costs get added to basis, that's going to tell you what on that HUD statement you get to add to what you paid. Some of
Okay.
the costs you get to write off right away, like you pay a little insurance, things like that, but a lot of the costs roll into your purchase price. So if you buy this $100,000 property, you might end up at like 112,000 and some change.
Hmm.
And then what you have to do is allocate an amount for the actual building, which is what we get to depreciate because it wears out, and
Okay.
land. And you can't depreciate land because
Hmm.
it's just land. It's just there forever.
Right.
So you're going to go to your county website, and they'll give you a tax assessor value on your property. And you're not going to use their exact numbers, but whatever ratio they use. If they say this is, you know, 25% land value and 75% building, apply that same ratio to what you paid to set up your depreciation. So that right there is the thing we see wrong probably the most. So
Mm.
if you can get that, like if you're spending time on something, that's the thing you really want to spend time on setting up correctly, because that's what you're going to get for years to come. And that's again what pulls into that biggest like tax benefit, is that sort of extra on paper only write
Right. A
off.
paper
So you
loss
want to make
against
sure
your
it's
real
right.
money. Yeah.
Yeah,
Yeah.
yeah, exactly.
Should they know to do this? Like, so if there should they be, I guess you should because it's your money, right? But what am I asking? So should I, like, if I bought another property, I need to go back and look at mine. I should say that. And so the should I know to go do that, or should my tax planner help
Yeah.
me with that from the get-go and on all my stuff?
So they should be doing it, right? But what I found, and when I worked for CPA firms too, a lot of firms do it kind of a lazy way or a wrong way and not the most advantageous way. So when you get your tax return from them, if you're paying someone to do it, what you want to look for, you'll get what's called a depreciation schedule. This will be a horizontal sheet, so it's one of the only sideways pages in your return.
Mm-hmm.
Always look at that.
Mm.
Make sure you check that because, like I said, this is where a lot of people, you know, mess stuff up, and you want to make sure you're getting all your write off. So the biggest thing there, that's always a red flag for me, is if you don't see a separate amount for land. So if they say, you know, we're depreciating $100,000 and you know you paid $100,000 for the house, you should have a little light bulb that says, wait a second, Natalie told me I can't write off land. Why are we writing off the total? There should be some of this backed out. So
Mm.
that's the one thing to look for.
Mm-hmm.
The next one is round numbers, right? So if you know you paid 100,000, that was your like purchase price, and the amount they list is 100,000, there's probably more costs that should be added to that. You probably paid for an inspection, title fees, closing costs. So any sort of exactly round numbers on that schedule, if your accountant did it, or if you don't see land separate, or if you did a big renovation or anything like that, and you
Mm-hmm.
don't see that
Mm-hmm.
on there, like any cost to set your rental up. So any of those things, ask them about before you sign off and file, because that's where we see just a lot of the mistakes.
Mm-hmm. What about you said renovation, because I have a lot of people that are buying, they're what are called burr people,
Mm-hmm.
right? And So is it the same thing? Anything different with let's say you do 2 of those a year? Anything like when you see people that do that, even if it's either light renovation now, people to get good deals, they have to go in and do a bunch of stuff. Are they missing things with that? They need to go back and look at their returns and revisit that stuff, their money they're giving away.
Yeah, yeah, absolutely. With renovations, so the kind of starting point where to think of it is that any cost to get your rental ready to rent
Yeah.
are kind of part of that setup cost. It's like startup costs for a
Yeah.
company.
Yeah.
So if you buy it for 100, but you got to put 50 into it, you're not going to get to just write off that $50,000 during the year. It's going to be part of that setup cost.
Mm-hmm.
So be mindful of that. The things that you should look at your return right now and kind of be like, hey, like what's going on with this? If you see this on there, like go ask your accountant. Is if you did a $50,000 like renovation, like a big reno, and it's
Mm-hmm.
listed as one lump sum, like if
Mm-hmm.
it only just says 50,000 renovation,
Mm-hmm.
because on real estate, like each asset has a life, which is like how long you get to write off a portion of it across. So obviously, the shorter the better. You get to write off more per year. A house is 27 and a half years. But a lot of components within a house are shorter. So,
Hmm.
like if you put in some new appliances, those are only 5 years. So, if in that $50,000 renovation is $10,000 of appliances, well, you might get to write those off over a much shorter life, giving you a much bigger write off. And then on top of that, the tax code has something called bonus depreciation. We've heard
Mm-hmm.
about this a lot this year because this is the
Mm-hmm.
last year for 100%. But that basically says anything with life under 20, you can write off a big chunk of it the first year instead. So, like appliances under 25 years, so you could just have written off that 10 grand. So, if your accountant's just taking your whole renovation and not asking you if there's like pieces of it, kind of
Yeah.
breaking out what you actually bought, you're
Yeah.
probably leaving a lot of money on the table.
Wow, that's huge. Is that, I don't know, is that cost segregation or is that something else?
Yeah, so kind of the same premise, right? So, a cost
Okay.
segregation, like if you buy a house, if someone asked you, like, you know, hey, here's what is the value of this refrigerator that came with your 25-year-old house? It's avocado green. What do you think it's worth today? I don't know. Like, I
Right,
paid
right,
for a
right,
whole
right.
house for
Right.
$100,000. But if you put in something brand new, we know the value. So, a cost segregation is having an engineer expert. They basically look at an algorithm, look at a database of information to figure out that like used value of all these
Mm-hmm.
components of your house. So that's what a cost segregation is. But even without a cost segregation, if you're doing new work on a house, we have values for the new flooring, for the
Right.
new windows.
Right.
So your accountant can
You just
break
have to
those
keep
out
good
even without
records,
it.
right? Just
Oh, yeah.
so it's not, 'cause that's a whole, I knew it was more of an engineering thing, but the same thing, just paying attention, documentation is huge.
Mm-hmm.
And I want to talk about that a little bit later because I to help them, they need to, document, it's
Yep.
like the help me help you, right? With the Jerry Maguire.
Yeah.
And what are I know I'm jumping around. I'm sorry, my mind is
No, you're
racing
good.
sometimes. Oh, we're good. So
Shaking it
I
up.
yeah. So give me another. So we talked about there's numerous tax benefits of real estate because really what I find is I was listening to a Kiyosaki interview one time, which I never heard him say this way. For example, he said the purpose of business is to buy real estate. Right. And in
Yeah.
Rich Dad's Guide to Investing, he says, or if I told people, look, if you study the people in the Forest 400, they build businesses and they buy real estate and they do the real estate. And the more, one of the things he says is that he always touts like, and nobody comes to lock him up. So I guess he gets away with it is, oh, don't pay taxes. Right. And he'll work with Ken McElroy. He says, yeah, if we had a good year on the business, I'd say, Kenny, we need another property. We need another,
Mm-hmm.
some more debt, right, to get another property. What is he talking about?
Yeah. So this is one of those disconnects a little bit because there is tax benefits with real estate.
Mm-hmm.
But there's limits on if it's an investment for you versus if you do this full time.
Okay.
So there's a thing related to real estate called a passive loss limit. So any losses created by your rentals are passive income. That's why they don't pay any of those payroll taxes.
Mm-hmm.
But the kind of flip side to that is if you create a loss, you can only deduct up to $25,000 a year of losses from your rentals, and only if your income, your overall income, is under $100,000. If your AGI is over 100 and up to 150, you can use some of that amount. Once you're over 150, those losses carry to next year.
Hmm.
So like they don't disappear, you don't lose it, and they can always offset other rentals. So if you have
Mm-hmm.
one really profitable rental and one that had a big loss this year, that'll always net together, same bucket.
Mm-hmm.
But you can't always use those losses to offset your W-2 income. For guys like Kiyosaki, Tom Wheelwright, all the kind of big investor guys you hear
Mm-hmm.
about, they're probably a real estate professional. So that's an
Mm-hmm.
IRS status where
Mm-hmm.
if you spend more time on real estate than any other job or business, if you're doing this full time, you're a full time agent, you have 100 units that you self manage, whatever the case is, if you're
Mm-hmm.
full time in real estate, that status lifts that restriction. So
Hmm.
now all of your real estate losses are non passive. So you can, there's some other limits you might run into at pretty high amounts, but for the most part, you can just create enough losses with real estate to offset your other earned income. So it's kind of a different set of rules. So like you'll hear guys say this and like it's
Right.
true,
Right.
but it's true for them. So then when someone who's like the 9 to 5 investor comes to
Right.
me and they're like, I have one
That's why I wanted
property,
to
I'm
make
not
that
supposed to pay
distinction. Right.
taxes.
Right.
That's
It's
not
a
always going to
difference.
happen.
That's why,
Yeah.
guys, you can't do your financial planning from IG. Okay.
Yeah.
Or 15 seconds on TikTok. Oh, I heard I could, write
Yeah.
off $100,000 car. It was over 6,000 pounds off my taxes. It's more to it than that. You
Yep.
should talk about that too. But because I hear they're not dumb things, but they're
They're
pieces of
flashy.
things.
Yeah. Yeah.
Yes.
TikToks, it makes me crazy. And it's what everyone does because it's like, it's sexy, right? They're like,
Right.
look at this thing. This is how I wrote off $100,000. But they forget to tell you like all the fine print, like at the end of a prescription
Yes, that
commercial where
drives
they're
me
like, my
crazy.
cause, blah, 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 blah,
Right,
blah.
right.
Like that's what they're leaving out. So you got to then like dig deeper to find out like, oh, this is a great strategy, saves you a ton of money, but it only works for this one specific person or situation.
Do y'all hear
So,
that?
yeah.
Okay, do some research. All right, don't So because the thing is, we want to spark ideas, but
Mhm.
it's your money, right? And even if you say, well, my accountant handles that, well, you signed it, right? So the IRS don't want to talk to them; they want to talk to you.
Mhm.
Okay, so you need to know. You need to. We always say business is a team sport, and so you need to lead your team. I'm a Star Trek fan, right? So Captain Picard is in his ready room and he asks his opinions, but he makes the final decision, right? And so for the nerdy people out there, you get that. The rest of y'all don't, have no idea what I'm talking about. But I'm a nerd. So I'm a cool nerd. I was also all city in basketball, but I was a nerd nonetheless. So let's talk about here's a biggie that I get that I want to clear up because I have clients that are so confused on this. Employing creating generational wealth, but really let's talk about employing your children. Why is that
Yeah.
powerful, and how do you do that, and what are the proper ways to set it up and that kind of thing?
Yeah, and this is pretty high on the list of things you'll probably hear kind of wrong on TikTok because
Uh-huh.
it's a big strategy. People love talking about it, but there's nuances to it. And you never hear about the fine print, but like it's great and it's legal and you should absolutely do it, but don't just assume the 15 seconds you heard about it is everything.
Right.
So, the reason we can employ our kids, there's a few kind of nuances to this. But if you earn less than the standard deduction on your taxes, you get to if you file a personal tax return, as a starting point, you get a standard deduction. It's about $13,000 this year. They say right off the bat, we're letting you cut this out of your income. So if you made less than that, you don't have a filing obligation because you're not going to owe any tax. It's going to be zeroed out.
Mm-hmm.
So what you hear is that, oh, you can pay each of your kids $13,000 a year, not pay any taxes. That's like in theory. It's up to that amount before they have to file any taxes.
Right.
But the kind of key to that is so they actually have to do the work for your business.
Yep.
And you have to
right.
pay them a reasonable wage. So you can't say, oh, I paid my 3-year-old $200 an hour to mop the kitchen in a rental. You could have paid someone else, $12 an hour. Like
Right.
you have to pay them the same you pay someone else. So when they're really young, it's hard to hit that maximum amount. Like if you're paying a minimum wage because they're a toddler, like how many skills do they have? They don't even have motor skills yet. So it's hard to pay them $13,000 worth of justifiable work. Like they have preschool and stuff. Like what are they doing all day? It's not a labor camp here. You can't just work your kids nonstop. But as they're older, like
especially my father.
Yeah. Right. That was the last generation.
Right. So was my father.
Yeah.
So okay, keep going. I'm sorry, I digress. I'm gonna flashback for a second.
Yeah. You're like, I didn't get paid for that. Wait a second. But you can absolutely have a
we had a bar,
when
right?
they're young.
And so I was running the bar. I was like, I don't know, 22. And I remember he paid me like $20 a week. And I was there from like
all day, every day.
all day, every day, because we didn't pick up till the night. And I was like, all right, I guess it's a family thing. And I literally got like $20, $25 a week. So all y'all like, oh, I need $15 an hour. Y'all don't, I don't want to hear it. All right, I digress, but
But yeah.
continue.
But yeah, it's something you can absolutely do and start doing it when they're young. And so there's a dual benefit to this. You get to reduce your taxable business income,
Mm-hmm.
right? And then we're moving it to tax free. So even if they're 5 years old, you're only paying them, maybe a couple grand a year. That's still a couple grand off your taxable income.
Yep.
That's now tax free. And like maybe now your kid's using that to pay for their school uniforms or to put into a college fund or whatever you're doing with it. On top of that, you can also, if they have earned income, you can fund a Roth IRA for them.
Mm-hmm.
And I was just doing some like rough math on this because I saw another CPA be like, how could this be worth it? Who's really going to get rich on $6,000 a year? And I was like, do you not understand the time value of money? Because if you, from the time your kid is 10, start putting that 60, it goes up to 6,500 a year for this next year into a Roth IRA, by the time they're 18, they're going to have close to six figures in there. And most 18 to 24-year-olds have like 4 grand saved for retirement.
Mm-hmm.
If your kid is starting off in the world with between 60 and 100 grand, depending on how much we can put in there, like that's huge. That is a huge benefit. And again, we're getting to reduce your taxable income. So it has to be a reasonable amount. I recommend start when they're young, raise it as they're getting older. You're teaching them more and more. By the time they're 10, they're going to know how to use the internet better than any of us. So let them take over your, social media and managing your mailers, all of that. Then you can pay them more, But yeah, then you can work up to that, and like age 10 on, it's pretty reasonable where you can be paying them the standard deduction of $13,000 plus putting 6,500 into an IRA. That's almost $20,000 per kid.
Right, from the 13.
On top of it.
Really?
Mm-hmm. Because just the amount they get paid has to be under that 13. The IRA is pre-tax. It's not going into their bucket basically. So separate situations where the money's going to end up. So they just have to on their taxes have it be under that. So you can put almost $20,000 a kid out of your business into their pockets, and we're moving it to tax-free income while setting them up to have a jump start on retirement. That's huge.
How do you document? So here's I got a person. So let's talk about, I'm thinking about specific people. Me. So the podcast is free consulting for Curtis. No, I was kidding. And I'm very silly now. You just met me, but I have fun while I do this. And I have another person who has a job, but has a let's talk about her first. A successful real estate business, has a son who's about 15 or 16. And so she heard from some MLM that she could write off her kids, but she doesn't know how to put them on payroll, or how to document it, or that kind of stuff. I want to go into a little bit of detail there, because I think people are missing that. And you can do it if you have like a MLM or something like that. You could do that. That opens up that self-employed or the business owner side of the game for you, right?
Yeah, any business. So this is a great point. I was actually just telling someone, I feel like I need to make a kit for people to basically be able to have for this, because you hear the strategy and then no one tells you what to actually do.
Right.
Like then everyone's over here being
Come on, I'm with you.
but
just let me know.
How do I do
it?
it? Yeah. But so there's a few things. So they do have to be on actual payroll. They have to be set up as an employee of your company. So if you have a tax professional or a bookkeeper you use or someone like that who does payroll at their office, they could probably do this for you pretty cheap, because you don't have to pay them every 2 weeks kind of thing. It just has to be reasonable and scheduled like a regular payroll, like having an employee. Just because they don't have a reporting requirement, like your kid might not have to file taxes, but you as a business still have that obligation. So you're still supposed to issue those forms. So you'll file your quarterly payroll reports saying, I had an employee paid them this much, but they're exempt from those payroll taxes. So they might just be zeros. You won't owe anything, but you still have to, it's just the paperwork. So you're going to get with a payroll, either like you can talk to Gusto or kind of one of those companies, but you might be paying more than you really need, because it's not like you have a full-time staff kind of. So I always recommend chatting with a local company first, but you're going to set them up as an employee, do your quarterly payroll filings, your year-end filings, W-2s. If you're going to set them up a Roth IRA, you're going to loop in a custodian who can set that up for you and get all of that. That'll come into your payroll. That'll come out of their paychecks. And it's treated just like a regular employee. And so you still just file the paperwork, same as if you were hiring anyone else. They're just exempt from those payroll taxes. There's a few nuances to this. Absolutely don't pay them as a 1099. The rules are totally different then. If even earn, I think it's $400 if they're a
Right.
1099, then they have to file now. So make sure it's set up as an employee. You also have to be paying them
Oh, it
either out
down.
of,
It's $400 now. Down
well, so
from
I think it's
600.
400 if they're a minor. It might
Okay.
be six,
Okay.
but I want to say it's lower if they're a
Okay.
kid. But
Okay.
I just don't pay
Right.
them any.
Don't. Right.
Yeah.
First of all, if it's a difference between an employee and 1099. So the IRS, if it walks like a duck and talks like a duck, because
Mm-hmm.
people get in trouble
Yep.
paying people that work at their office every day. They want to pay them 1099. It's like, nope, that's you're gonna be up there next to Wesley Snipes. No, just kidding.
Mm-hmm.
He's out now.
But
He's a
a
great actor.
little rough
Whatever.
patch.
Right. And but so even if I have they have most people say, well, I got a LLC. So I'll say, well, what type? Well, they think that's a tax strategy, first of all.
Yeah.
And
Yeah.
a single member LLC. I said, no, you just basically filing a Schedule C, and
Yep.
which is the second worst way to be in business, okay, other than a partnership. Okay, I've heard. You could correct me. And but so they could still. This is the point I want to make. They could still get a payroll company and run real payroll, even though they have a Schedule C or sole
Oh,
member LLC to
yeah.
do that for their kids.
Yeah, so you can do this either in your personal name. So if you're operating as a sole proprietor,
Yeah.
you Joe Smith owns a rental, or you Joe Smith, signed up for an MLM or have a car detailing business, whatever you're doing.
Yeah.
If you have a single member LLC, you're good. If you have a partnership that's just you and your spouse, it can only be the parents who are partners
Right.
who can still do this and pay the kids out of it. If you have partners that are, friends or anything like that, it doesn't work anymore. Then it is subject to payroll tax. So it's basically, it has to be the parents paying the kid without anyone else
So my
involved for it to
11-year
meet
old.
this loophole.
Yeah. So so I have I have a 19 to 21-year-old. So I literally run payroll for them out of the Practical Wealth book. But I have an 11-year-old, and I'm getting ready to put her to work in something. Okay.
Yep.
You're smart enough now. You're gonna use a computer. Okay, you come to
Yep.
work for daddy, right? Teach you to be a capitalist. And but right. So what I'm hearing is I didn't know how to do it. I should just call them and just put her on payroll and just send
Yep.
her.
Yeah, and then set up a normal, basically a job listing, right? So you've got to, like I said, they've got to actually be doing the work. So create a job description, same as you would for any other employee. Here's the kind of work you're going to be doing.
Yeah.
Here's what we're paying you for it. Here's about the amount of hours you should be working. Because especially if it's something, because like one of the like guru-y strategies you'll hear, they'll be like, oh, you can even pay your 2-month-old baby $13,000 a year. Say they're a model and blah blah blah.
Right. I was about to say
Like,
that they're a model, right?
but the problem is, you can hire a kid model to be in
Right.
like your marketing, and it costs like $300. So like, I'm sure your kid's cute, but what makes them 100 times cuter than the professional? Right. So it's got to be reasonable for what you could pay someone else. So like saying your kid's a model, trying to max it out, that's a little too aggressive.
Right.
But like even when they're pretty young, if they're 3-4 years old, they could be putting stamps on envelopes for direct mail, and they can be sweeping up at rentals. They can be like, there's still stuff they can be doing, it's just maybe not $13,000 worth yet.
Now that's a huge benefit. Let's talk about another one. So one of the things I think the smaller investors don't see themselves as a business, right? So literally you have a home-based business if you're an investor. Is that right?
Yep.
All right.
Yeah.
And so if you have a office or a kitchen table that you are looking at your rent, collecting stuff, running your business, analyze properties, there's a strategy. So the strategy I've heard it called is income shifting, right? So let's say you have a job, and now if you have a business, you can shift some of that, like, so business use of your house, that kind of thing.
Yeah.
Let's talk about that a little bit. I think that's huge in terms of keeping more in your pocket.
So this is one of those other things where, again, why real estate can be a huge benefit, or any side hustle, because there will be things you are already spending money on personally that we can now take a portion of it and write it off, whereas before none of it was. And this is another thing where, again, you'll see, this is like the podcast of like discrediting TikTok, but you'll see people be like, just set up an LLC and run all of your personal expenses through it. Now they're all a write-off. Like, that's not how it works. It still has to be an actual business. Like, it has to actually be something related to your business,
you be trying to make, I always tell people, if I was trying to convict you for the crime of having a business, There needs to be some evidence, right?
Yeah, yeah,
That you're
exactly.
trying to make money. Okay.
But yeah, like stuff you're already paying for. So like personal cell and internet is a big one. You're paying for probably $100 a month for a phone plan.
Yep.
IRS typically we go 50 to 70% is what they like have allowed in audit. So
Mm-hmm.
if you're using that to manage your rentals, you use a text, whatever. Then we can take 70% of that cost now each month, or 50% if you want to be a little more like conservative about it.
Mm-hmm. Mm-hmm.
But same with your home internet, right? Like you're posting your properties on Airbnb from your home computer, you're doing all this stuff. The computer you bought to do all of this stuff on, the new cell phone, and then a home office. So like your kitchen table wouldn't work. It has to be a dedicated
Mm-hmm.
space, not even a room, but it just can't be like something you also use for
Right.
like,
Okay.
right.
Mm-hmm.
But like if you just had a desk set up in the corner of your living room, or if you have a whole office space, if you are paying, $1,200 a month rent for a 2 bedroom, and say 20% of the square footage is your second bedroom that you're not using right now, it's got the Peloton in there that we all bought during COVID and we just like ignore now. You
Right.
can take that out of there, set up a desk, and write off, that 20% of your rent each month for managing your properties. And I wouldn't do this with one rental, but if you've got a few rentals or if you have an active business, absolutely.
Yeah.
So yeah, with that income shifting, it's about, what things are you spending money on anyway? And do they have a partial business use? Can we now actually get you in a better tax position for money you're already out of pocket?
Yes. I mean, it's key. Document.
Mm-hmm.
Right. Get a. I'm not even gonna name anything because I'm trying to get an affiliate program for. But I'm gonna find a link for this thing I'm thinking about. I can't get a name right now. But you got to document. I think like crazy.
Mm-hmm.
Which not even just for that, just so you can know your numbers. Like most people don't even know how to read their like profit and loss, let alone run one, And so I
Yep.
think that one of the things Kiyosaki says in Rich Dad is, people talk about financial literacy. Well, financial literacy is accounting,
Yep.
right? It's the ability to read numbers. The numbers tell a story, so you've got to be familiar, and then now you can look at that. I'm going to ask you. So now let me just count the ways we've saved y'all money. Okay, we talk about income shifting. Can you speak to this? I told you I'll just let this flow, right? So the one part of income, this is for W-2 people, right?
Mm-hmm.
And because they keep changing the W-4,
Mm-hmm.
right? And so like if people think, oh, I got a $6,000 refund, and they're excited, right? And I'm thinking you overpay the government to tune of like $500 a month.
Mm-hmm.
But if you combine those, because people think allowances and exemptions on your tax return and allowances are the same thing. The allowance on a W-4 just tells the employer how much to withhold, right?
Yeah, and they got rid of them on the new one too, so it's even more complicated. So I've seen a ton of people not withholding enough or withholding way too much,
Yeah.
or yeah.
I gotta, I'm trying to figure out, because there was a thing, now correct me because I don't go saying, I don't want to be the TikTok guy, that for every 4,050 of, what's the word? Deductions. So let's say if you've got the 20% of the house and the car and the internet, and it's over $4,000, that's like an additional allowance. So now you can write it off again, so even if you raise your allowances so you get more in your check, you won't owe because you're offsetting it. Like that's a huge
Yeah.
strategy. You just got to dig into it a little bit deeper, guys.
Yeah, and so that's sort of a kind of the way you'll hear like a 1% rule for real estate. That's just sort of a general. So be real careful because there's limits on a lot of write-offs,
Okay.
right? So you don't want to like expect to be able to write off something and so you pull way back and then you end up owing later. But there's an IRS withholding calculator, or you can do an estimate throughout the years, especially if you have an accountant.
Yeah.
At the end of quarter 1, give them your year-to-date pay stub and say, where am I at? Am I over?
Yeah.
Am I under? But a great kind of starting spot is I'll get people who come to me and they're making, 100 grand a year. And if you just look at their withholding, like if you just take the amount of withholding on your paycheck and divide it by your amount of wages, if that's less than 10%, there's a good chance you're not withholding enough. So like just sort of look at that. And if it is at
that's
that
a good
point,
rule of thumb. I never heard that. Yeah.
take a look at your
that's
tax
awesome.
return, just because that's kind of the lowest bracket. So if you're holding less than that, depending on what you earn, but go to your accountant early in the year, that first quarter, and have them do a more advanced version of that, where then they look at also your business income. If you've got a side hustle and your income's pretty consistent through the year, they can take that into account. They can take your rental and Like they can look at all these things and say, okay, well, you earn $90,000, so you'll be able to use any losses from your rental.
Yeah.
Because of depreciation, your rental is going to give us a $5,000 loss. So even if your job is creating $90,000 of income for you, you're only going to be paying taxes on 85. We know that now. We can reduce your withholding a little. So having these educated like estimates, what that's going to let you do is you're like, big deal. What's, $5,000 worth of difference or whatever the correlating
Yeah.
amount is. Well,
Yeah.
if you take that money now and instead of having it, the IRS holding on to it all year for you, you put it in a high yield savings account out of each paycheck instead. So instead of paying too much money all year long to the IRS and getting back, $6,000, $8,000 at the end of the year, and you're all excited, but you were lending them that money all year for zero,
Right.
for
For
0%
That's right.
interest.
That's right. And this is what I've seen, Natalie. They will. I was going over client stuff, and I was like, "Why is this guy so broke?" Because he was making like 110,
Right. Where's it
120,000.
going?
I'm
Yeah.
looking at where's this money going, right? And so in my mind, I have a checklist, okay? Because I call these the wealth transfers. How you pay your mortgage, taxes, how you fund retirement plans, educational expenses, and like financing, big ticket items. So I'm going through my mental checklist. It's like, all right, he's not sending extra on the mortgage. Taxes. I said, you get a tax refund? He goes, yeah. I go, how much? He goes, $12,000. I was like, what? I almost fell out. And then he had an extra $25 withholding. I said, and so here's the other part of that. So he had about $600 or $700 in overdraft fees
Oh.
through the year for his bank, right? And he had like a $5,000 credit card balance. Why? Because he was messing up his cash flow and then putting it shortfall. And so now what do you do? He gets a refund. He's going to he's been carrying on credit cards at 18, 23%, and then just turn around, get the money and give it right away. And it's like you have to look at your stuff in total.
Yeah, and I hate hearing stuff like that because I think so many credit cards and banks, there's so much predatory nature to it. Especially in like certain communities, they do everything they can to sign people up for accounts where you're going to pay every kind of fee you can.
Right,
They're going to overdraft you for everything. So the biggest like things I push people for is if you can open a small like revolving line of credit with your bank or something there too, where it's hooked up. So if you do, mess something up at overdrafts, it will pull from there instead of charging you a fee. Like there's your first safeguard. With like, so I'll hear this from people too, where they're like, I like getting that tax refund because I'm bad about saving. It's forcing me to save.
Right.
But another tip I have that I heard from a banker is on your online banking, you can have a hidden account so that when you log into your online banking, you don't see it there. It's an account. You can call the bank and get your money if you need it, but it is not on your app, your login.
You can't see it, right?
So you can have it set up instead of that extra, $200 a month your client's withholding given to the government. Have it put into that secret account. In your brain, it's not there. You can't see it. And at the end of the year, that's been earning interest all year. You've been saving without it being a 0% loan. So having something not linked, so it's kind of hidden and forcing you to save almost, like things like that are huge. And these are the things I wish they taught this in like high school, because if people got in these habits when we were like 18, I feel like it takes most people a lot longer. So just getting
they
things
need
like
to
that set up
teach
when you
taxes,
can.
like the stuff that you're talking about. I mean, your number one wealth transfer is taxes, but nobody understands the tax return. Even most, financial advisors, that's why I'm committed myself to. I was on a newsletter I have, and the guy said, look, he had me go to he put a link in there. And so I printed out the 115 pages to understand how to complete the tax return. So I'm committed to be conversant, and knowing what I'm looking at. I don't want to do them, but it's if it's your number one thing, you need to understand. I think, you need a Natalie in your life. If not her, somebody like her, right? Where that can be on your team, because business is a team sport. And so that being said, Natalie, I want to respect all your time. Anything I forgot to mention that you want to say, and then I want you to tell them how to follow you, how to see what you got going on.
So the one other thing I'll throw out there, because we were kind of talking about this and it's year end, so I hear this a lot right now, is people being nervous about bonuses. They think if they're getting a bonus, they're going to pay more tax on it. But that doesn't happen. So like if you're getting a year end bonus at your job, you don't pay any more tax on that than you do every other paycheck. They just hold more of it. So this is what we were talking about earlier, like with withholding being too much. Because to them, the HR just by default sees a check for $10,000 instead of $2,000, and they're like, oh no, we better hold a bunch more.
Right, withhold $2,500.
But when you file,
I have people
get
get
back.
like $30,000, $40,000 bonuses, but their withholding is big.
Half. Yeah.
And boom, it's like, where's my Yeah,
It all goes in the same bucket, so don't freak out about a bonus. Like, still realize that you're still going to pay your normal income rate. And also, if you're getting a year-end review at work and you're going to get a raise, a lot of people be like, "Oh, I don't even want it. It's going to push me in the next tax bracket. I'll make less money." That's not how our brackets work. You're taxed on all of the income up to that next cutoff at the
Yeah.
lower rate, and only whatever's above it at that higher rate. So if you're going from, if $100,000 is the cutoff to hit that next bracket, and they're like, "You did an awesome job, we're going to pay you 125," take it.
Right.
Only that new 25,000 will be at the higher rate. So those are two things I think
Ooh,
a
that's a
ton
whole
of people
podcast
don't
in and of
even
itself.
know
Yes.
about, and like,
Yes.
get
The
that money.
progressive
Do not
tax
be
system.
scared of it.
Get your money. Okay.
Yes.
And yes. Amen
Yep.
to that. Get your money. And all right, I'm gonna stay focused because you didn't hit got like 5 things running through my mind right now. So Natalie, this is awesome. I thank you so much. And tell them that's huge actually. And what how can they follow you? Where do you want them to go? You know,
Yeah.
and get with this young lady. I was gonna say girl, but that's
Yeah.
politically correct. Get with my homegirl. No, it's
Been called worse on a podcast. That's fine. But you can find me on Instagram. It's probably the best spot. I'm RE_tax_strategist. It's the same on most social. I think YouTube is real estate tax strategist. And you can hop on my website at kolotax.com. I try to do as much as I can to put out kind of free information and updates for people, because stuff like this is important, and you guys need to know what to look for even if you're working with someone. So yeah, come follow along and ask your questions, and let's make sure you're set up right.
All right. You heard her. And so find out, you got to do a deep dive in this stuff, because I'm telling you, this is your number one expense is taxes. So you have to pay attention to it. You can't just put your head in the sand. And this has been fun. See, taxes are fun. Okay. But we're talking about saving money in taxes.
Yeah, exactly. When it's keeping your money, that's the fun part.
And that is the fun part. And so that's good. And just paying attention to the stuff, looking at it, it's just like getting control of your overall finance and understanding that, this is a discussion you need to have. You need to have a good team. You need to educate yourself, because as you educate yourself, you'll keep more of what you make. Absolutely. Natalie, thank you so much for being on the Practical Wealth Show.
Yeah, thank you for having me. Had a fun
time.
You're doing
once a quarter, because people need to talk to their person like once a quarter,
Yep, yeah. I'm always telling people, because this time of year is when people start reaching out for tax advice, and like, the year's done. Now we're playing. This is when you start looking for someone to work with next year, so your 2023 is set up right.
How about that? Right. And so if you're taking somebody a box of receipts like in March or April, or that's all that period person wants to talk to you, I call that person a historian, right? Because there's nothing they can do for you.
Yep.
Right. Just fill your stuff out and here's what you owe. Can you send me some money? No. And then they'll just put some money in the IRA, something basic like that.
It's reactive.
So, right. It's reactive. And you need to be proactive when it comes to taxes. So absolutely. I'm not going to go off another tangent. Natalie, thank you.
Yeah, thank you.
This has been fun. And guys, follow her. We'll put all of her links in the show notes. And, you still have as this comes out, there's still a couple of weeks left in December. So start thinking about it. Start thinking about next year. And guys, go out there and make a great day. Natalie, thanks again.